Good morning, everybody. This is Patrick MontesDeOca with the VCPMI early morning update for January the 4th, 2020. The first thing I want to do is I want to thank everybody for all of the support that you gave me in 2020, and I want to wish you a very, very happy and prosperous 2021. The market right now is setting up for 2021 to be a very exciting market. If we take a look at the gold market right now, trading last at 1948, up $53. In one day, $53 is a pretty substantial amount of a move in the gold market. And the thing that I want to prepare you for, which in essence I'm, talking to myself as a self-directed trader, is the fact that we can see this kind of volatility expand more into 2021 to the point where we're going to see potentially some moves that can exceed a couple of $100 in the gold market. We're looking at silver up $1, $2 in a short amount of time, in a matter of a week or so, or days. And so expect that as we move into this 2021, we are going to continue to see this kind of volatility increase, particularly in the gold market, as it begins to relate basically to the fact that the government is printing, or pretty much are going to have to print more than I think what any political discussions have been made recently with regards to the stimulus. So we came into this market from the long side, and I want to pretty much take a look at what's happened here in the market. In terms of the VCPMI, the daily numbers that you see on the left of the chart pretty much have been completed. So the daily pattern has gone neutral above 1914. It has completed the targets of 1914. And on the right of the chart, you see the weekly numbers coming into this week. 1913, 1925 were the targets that we were looking at as we came into this week. Now, the market continued to move up, particularly into that monthly target now for the month, which was the sell one level. 1950 is the sell one level as we come into this month, and the sell two level is 1998. So far, we have seen a high of 1948.70, not quite completing the target of 1950, but it appears that we are on our way to do that. So we want to keep an eye on the monthly signal as we begin this month of January 2021. Is going to be a very critical month, and we want to see how the market basically reacts to this target, so to this area of distribution of supply that we're looking at, which is in the 1950 to 1998. Taking a look at the silver market, pretty much we have the same pattern. The daily has been negated, completed above 27.12. Now that area is serving as support. The weekly targets of 27.48 have been completed, and so now we're looking at the monthly targets pretty much to be completed here as we continue to move into the sell two level above the weekly, which now represents support. Once again, when the market breaks that resistance level, it becomes the support. So we've gained quite a bit here today. So what I'm doing here is I'm locking in some profits. I'm suggesting my traders to hedge up here as we lock in the targets, as we complete the targets. And as we take a look at the monthly, pretty much, or we're looking at the 1950 to 1997, 98 area. We are entering a weekly, obviously in a daily overbought condition. The market is trading above the daily and above the weekly, obviously, and almost completing the monthly target of 1950. So let's take a look and see. The Bollinger Band here. Pretty much confirming the market is in the upper end of the band, which represents resistance. So we want to see, let's see what the market does up here. As I recommended here, locking some profits, hedge. Don't take out the long side of the market, but you can, depending upon your profile, you can hedge it in a way that you can create a synthetic position for yourself. Depending upon whether you're long shares or you're long ETFs, you can, sell out of the money calls up here. There are a number of ways without eliminating basically the continued uptrend in the market. But we are getting a little bit of profit taken here. In silver as well. 2748 represents the sell to level target. And so we're trading above it, which essentially brings in the monthly, activates the monthly target unless it closes below 2748. Then it begins to activate the weekly, obviously, sell to level short trigger. Yeah, we see we're getting a lot of profit taken here as expected. The code is telling us it's rich up here. The market is overbought, and the path of least resistance up here now is to obviously revert possibly back and test this previous levels of now support, which are the targets that were completed as we came into this week. Didn't quite get up to 1950, which was the sell one monthly. And now we have reverted, and let's see how far we can go. Let's take a look at the E-mini. The E-mini S&P activated a daily short trigger here early this morning at about 5:45 a.m. And the target of the average already has been completed on the daily, and it seems to be coming down into this level of 37.26, which is the weekly average for this week, and also the buy one level of 37.25. So it's entering that area harmonically of buy one and average weekly. And also interesting enough, when you take a look at the buy two level, it coincides with the buy one weekly level. And that is a pretty, strong area of alignment that we have here. So we seem to be identifying the E-mini S&P between 37.25 and 36.99 as potentially a major area of support that may attract buyers in the market. So let's watch that market as well, and see what it's trying to tell us here. Let's go back to the gold market here, and we can see this supply came into the market, basically, is what this green red bar represents. And so now we're letting the market test the supply and demand up here, and we'll see whether buyers continue to be greater than the sellers that are showing up here, and that's going to reflect in the price. So we're allowing the market to trade here as we come into this first trading day of 2021. The market continues to hold these levels here, up 42.50 in gold, 1937.60 last. The market rallying up here into that 1948.50 gave you, a self-directed trader, if you were long the market, obviously the opportunity for you to trade around your position, depending upon what it is that you have, whether you have future stocks, ETFs, options. It was a great opportunity to lock in the balances, which is what my goal is as a self-directed trader. On my core position, I want to maintain my long-term balances increasing on my core position as the market continues to pretty much to move in my direction. And when we get opportunities like today, for example, where we get a $50 move on the upside, and we match all the other indicators, giving us a a high probability that, this market may revert from those levels, then you can use, as a self-directed trader, that intelligence for you to position yourself accordingly. If you're long, you can hedge, you can reduce some of the profits here. We haven't identified any day trading opportunities here for day traders because the market opened sharply higher, obviously. And, it doesn't surprise me that on a sharp move higher like this, or when it comes in sharply lower, you usually get a little bit of a correction, you might say. So this was a great opportunity to lock in some profits. Now we've been recommending, my traders here in my private trading room, since the market made the low of 1767 last year, at that point, that potentially that might be the low for 2020. And as it turns out, that was the basis, you might say, that represents the low for the year of 2020 that we are using as a measurement to move forward with analyzing where the market prospectively could go to in 2021. The fact that the market came above 1912, it broke out of the upper end of this resistance that we've been trading against. And not until now, obviously, we firmly established interest up here at these levels. And, we got up to 1948.70 this morning. I think the challenge or the target the market wants to accomplish is the previous high here that we saw recently into that 1785 area, 90 area. And I think we are able, if we can get through that level, the 2000 handle becomes very real again in the gold market. And I think we are lagging to a certain degree in the gold market, simply because I think that it continues to show tremendous manipulation in price, particularly on the short side of the market, that continue to show commercial banks have record short positions that exceed, I believe, about $40 billion at this point. And we'll take a look at this week, according to the Commitment of Traders report, and see whether they have reduced their positions up here or they have continued to increase the short side of the market, which is really what I believe is keeping the price, or the lid on the price, in silver and in gold or other precious metals here from taking off. The market in the gold has changed its paradigm, basically, from, again, what it used to be, which was traded more as a commodity based on the supply and demand, to what it's becoming more is a competitor asset to the U.S. dollar. In the real world, the prior to 1971, obviously gold was the gold standard behind the U.S. dollar. And once Nixon eliminated that in 1971, the gold market went into a fiat world that allowed for this bubble of debt to be created, basically on a debt economy. And the levels of debt that we have right now are, by historic standards, unsustainable, particularly when, we're talking about interest rates in, into that zero or negative rates. With the pandemic still pretty much upon us, and we still have not yet seen a turn, you might say, on the curve of the pandemic here. It looks like we are still going to continue to see some economic pressure building up, and also a lot of more pressure as we move into this new administration, that more stimulus is required. And I think we're going to begin to see staggering amounts of stimulus to come into the market. The market, as we move into this first quarter, and we begin to see the recent additional casualties the second lockdown pretty much is having on the economy here, we're gonna see that the economy demands a lot more stimulus than what most people would think. And in fact, that I think it's not only in the U.S. economy here, but on a global basis, the Eurozone and the United Kingdom, and I think our European central banks and U.S. central banks are on the path of least resistance here with regards to stimulus, which is to print as much money as the system needs. And it really needs right now greater amounts of stimulus than what is politically kind of trickling in to the economy. The fact that back in March, the Feds acted rather quickly and did provide the market the confidence that they will be behind, so to speak, the yield curve in supporting just about every class asset that you think about, including junk bonds and ETFs. And it gave the market the assurance that somebody's going to be on the other side of the market, and that's the government. And so we have to see how this resolves itself in terms of the U.S. being the buyer of last resort, and hopefully the markets will react to this in a positive way, where we can begin to see some kind of economic growth. But with 20 million people unemployed in the U.S., potentially more, and as we continue to see this lockdown affect businesses that were on the verge of recovery, so to speak, with the prospects of economic recovery here before the second lockdown, and not only are we dealing now with this with the economic consequences of that, but we're dealing also with some issues regarding the vaccine distribution. Logistical problems seem to be now part of the equation. And so there's a lot of uncertainty in the market here. And I think that's one of the reasons why we're beginning to see a bid in the gold market. And I think more and more as Main Street begins to realize that what is necessary is, again, to print unlimited amounts of money, unheard of amounts of money. It will begin to react, I believe, in a violent way, particularly in the silver market. The silver market is the cheapest asset across the board if you compare it to most class assets. But it is not for the faint of heart. It's a highly volatile market. And so depending upon what it is that you're trading, make sure that you don't over leverage yourself if you're trading in the futures contract. And, manage the position according to your profile, because it is a highly volatile market. It's one of the highly volatile markets in precious metals, but it is what some people call God's, poor man's gold, so to speak, or God's money, that it makes it available for most people, particularly lower middle class or in developing countries, emerging countries, the ability for the low middle class to be able to, buy a little protection, so to speak, because it's still relatively cheap. And I think if we begin to see what's happening, particularly as a consequence of this collapse that we're beginning to inevitably see on the U.S. dollar, you can see the ripple effect, so to speak, begin to unfold into even some of these other economies that are dollar related, that are holding U.S. Dollar, U.S. assets in U.S. dollar denominated terms, or as the U.S. dollar reserve currency. And so anything that is related in U.S. dollars as an asset pretty much is going to begin to feel the impact of the implosion, you might say, of its purchasing power. You might begin to see the risk that we have here, which I already begin to see. Inflation is pretty much in the cards. And, I've been anticipating, and I've been preparing, and I've been warning my subscribers, my traders here, that you want to take even at the possibility that we, could be going into food shortages, obviously. And what you see here as tremendous lines that are, particularly in need of food and immediately in need of food. What I'm talking about is not only the immediate need of food that's available, you might say, in inventories, but I think we're going to be dealing with the supply chain that has been broken, and the inability for us to be able to do and export the amount of food quantity that we need. Not only that, but we already are beginning to see problems developing in producing nations and soybeans and corn, and it's due to the economics, number one, and also the pandemic, the inability to be able to go into the fields because of this tremendous pandemic that we're dealing with right now. And so we definitely, I believe, are taking a look at much higher prices here for pretty much commodities. When you take a look at soybeans, for example, that I've been talking about, we're trading at 13.24.50. The high was 13.49.50 a bushel. This is the what I look at is the indicator in terms of food inflation, food prices. And when you see the price of wholesale soybeans go up 50-60% in a matter of months, 808 was the low back in March. We're looking at 13.49.50 as of today. This represents what's coming, which is that we are going to see high food prices. This will filter into the retail business, and it will translate into inflation in the food sector. But the supply chain that is broken. It's not only affecting food or food supplies, but just about every sector that is in production. That includes, obviously, in the gold market, gold mining. So in terms of the coming back in terms of the gold market or the gold sector, which is one of the reasons why I fall upon the precious metals is because the metals do take into account what all of this stuff I'm saying to you, and as an economic indicator, it does react to, for example, inflation, food prices increasing, and or the stimulus that's coming in, which is really bearish for the US dollar as it erodes its integrity in terms of its purchasing power and intrinsic value. And once again, when we go back to the law of economics of supply and demand, the core basis, obviously, is the supply and demand factor. And that applies also for a currency. So if you are announcing basically that you're creating endless amounts of supply, in this case, the US dollar, the intrinsic value is going to implode. It's the other side of these policies that they don't talk about and have pretty much, created all these formulas that do not include the real numbers that are being represented in the price of goods, commodities, food prices. The one thing that I believe is yet to be reflected in the price of gold is the velocity of money. And that is pretty much that once we come out on the other side of this pandemic, and, in 6 months, potentially, we have that probability increasing because of these viruses that are being created. The problem is, how fast is it going to get to Main Street, to the population that needs it? And so you're talking about, again, politics, and you're talking about logistics issues, and if I have to bet on waiting for the government to be efficient, I would say to you, so far the evidence is against them. In terms of being in control and being able to manage this pandemic more effectively. My opinion is that there is a lot of uncertainty out there, not only economically, but politically, and with regards to, obviously, this pandemic as well. And so that nervousness not only creates fear and panic, and people begin to look for safe havens, to protect their net worth, their wealth. And, most of the time, obviously, whenever you get economic chaos on a global basis, people run to the US dollar, which is the safe haven that historically, has been applied, so to speak, as a safe haven asset. But when you put into the equation this monetary policies that need to be implemented, and the future faith of the US dollar doesn't bode well unless these policies change. And I don't believe they will. I don't believe they are. I think we're going to get more into a debt economy. I think as we move into this economic summit that's being anticipated in Davos, what we're going to see is, moving into a virtual economy, and pretty much another dimension of a debt economy, a virtual dimension of this debt economy. The difference is that that economy has no debt. If a virtual currency is created in that virtual economy, you're coming into a clean slate, so to speak, with regards to the debt, because the debt is in the real currency, in the fiat currency of the US dollar. So how is that going to affect, the trust and faith, so to speak, of having the US dollar as the world's reserve currency? Or are we moving into a virtual world, a virtual economy? Bitcoin is obviously exploding. It, breaking record levels here, and is obviously Bitcoin going to be the virtual currency, the favorite virtual currency, you might say, into that world economy? I think we have yet to see. A lot of speculation has moved into that area and is at risk. When you're taking a look at, GBTC trading at $35,880. GBTC is the great scale Bitcoin trust that we trade and we watch. And it's pretty much breaking out. I mean, it's 3660 was the high that was made here today. And it's just breaking out. As you can see, back in March, it was at $5. Right now it's at 36. So, easily in excess of 71, bang, into the return. A 7-to-1 return since March is a phenomenal move, and also a very highly speculative move. And so the question is, is this going to be the currency that's going to be replacing the US dollar, or the virtual currency that's being created into the virtual world? I think we have yet to see. But so far, what I look at when I trade in Bitcoin or GBTC is basically I look at it as a trading asset. Great volatility that for self-directed traders, it's a dream come true. So it's a trading vehicle, trading instrument. We take a look at some of the derivatives here that are like Nugget, that are 2-to-1 velocity. These are aggressive instruments that you can trade and hold overnight, you might say, for a short period of time. They're not to be traded or held, so to speak, for a long time. GDX is the index, mining share index here. We have the minor and the majors. GDXJ is the major. And so we trade these markets to capture the core long-term direction of the market that obviously you can see is headed in the direction of much higher prices here when it comes to the gold market. Any correction here should be bought, as you can see. Whatever selling pressure came in prior to this 2 bars here, the buy-in interest that came into at these levels here is far greater than the selling pressure that you saw on this previous 2 bars. And so we're back up above 1940, and 1950 is the target that we're looking at as the monthly target. If you did not buy the market here coming into this rally, I would be very cautious, to buy the market up here, as opposed to waiting for some kind of dip correction that inevitably will come in the market for you to enter if you're not in the market. If you're long, congratulations. Enjoy the ride and continue to hold on to that position. If you're a short-term trader and you have a core position, these levels up here are giving you the opportunity to lock in some of the profits short-term, recalibrate, your balances, trade around, make sure that you manage it according to your profile and produce or benefit, you might say, by the tremendous move that we've seen in the gold market here today. We have a gap all the way down into that, above 1900 as we closed last week, 1899, which is the average for the daily. So it would be great if we can get another chance to buy at that level. But we'll see what the market wants to do here. For now, it looks like we're getting back up on the green side. Let's see if we have enough muscle on these buyers here to challenge that 1950 target. A little bit of consolidation here, trading last 1943.60, up 48.50. So the market is holding its gains here nicely, as well as in the silver market. We are trading up here, 43.60 last, up 48.50. Kind of hanging around here, there's levels here. The fact that the market broke through that 1912 now is pretty indicative that that 1980-90 target is pretty realistic to be challenged here. And I think that's what the market is telling us. But once again, it gives us the VCPMI gives us the AI of these pivot points that are target zones for us that are activated with probability factors behind it that tells us, you're in the 90-95% probability area where we can expect a reversion to the mean to occur, and use those levels basically as opportunities to provide some short-term trading opportunities. We're going to be posting the year results that we had last year, and they are phenomenal results that we accomplished here, trading live in Ticket Talker right here. The silver market is holding above 27.48, which is the support level now, as we broke through that resistance coming in this morning, and we're trading at 27.50. Now, if it closes below 27.48, it could activate a short trigger, but that would be a short trigger signal that would be activated with a 90% probability that the market could revert back to the level below. It doesn't necessarily have to do that when the signal is activated, because the signal can get negated on a close above it. So it follows the probability, the momentum indicator, you might say, that the gold market, or the silver market in this case, provides as a trading opportunity. So at 8 o'clock, basically a close below 48 conservatively would activate a short trigger. Now, it doesn't mean if the signal activates a short trigger up here that, again, it has to unfold into that, because only the market will decide whether it has more sellers up here than buyers, or more buyers than sellers to reflect on the price. So that's why we use the reversion to the mean principle, so that if it does revert it goes back up above, so to speak, after, let's say, it activates a short trigger at 48, you can use that intelligence to manage your trade accordingly. So using the VCPMI to me is basically as a GPS for my trading. It gives me the levels that I need to identify the extreme levels above supply and demand for that trading session, whether it be daily, weekly, or monthly. And I use it also to position myself, on the big picture here. The derivatives are very strong in the gold market here. Shares, very strong. The stocks, all the derivatives of the gold mining sector are very, very strong this morning. So if you're long on those instruments here, you're gaining quite a bit of equity here this morning. I personally, I am sitting very comfortably at these levels here, and I am not looking to change my long-term position in the market here, although I have used this rally to lock in a certain amount of profits here that I made coming into this morning. And I believe if you're coming in here live watching this hour live trading here, that, if you just follow some of the recommendations that I've given here, it should have been very helpful for you as a self-directed individual to be able to produce what I believe is some tremendous results. So one of the reasons why I once again do this live streaming, and I thank VCPMI for the opportunity to do this, is because I can show you how I use it, how I'm applying this in a real time, real account. And you, as a self-directed individual, you can decide based on your profile, what you can do. But I think it's pretty neat that this tool works the way it does, and it gives us the ability as a self-directed trader, to take advantage of this and trade the market accordingly. This is one of the great things that I love about the VCPMI, is that it gives you, self-directed trader, the opportunity to be independent, to be in control of your destiny, pretty much, and with the condition that we're in right now, these markets are providing an incredible opportunity for you as a self-directed individual. If you're in a position to take a risk, and if you have some liquidity, these markets are giving you the opportunity not only to benefit by trading these markets here, but also to provide you with the ability to protect your net worth, to use some of these instruments here to reduce the risk and exposure that your assets may have in US dollar denominated terms. And essentially, what we're doing here is we're using the gold market, as you can see here, not only to be able to speculate and trade over the short term, but to make fortunes. This is what I believe this opportunity is doing. It's giving you a chance to take a look at this, because fortunes are going to be made. Fortunes are being made on this pandemic, on this economy. As terrible as it may be, the other side of the coin is opportunity. And if you use it intelligently and prudent, decisions are made, I think you have a great chance to think outside of the box, and also to create for you an independent opportunity to be, financially independent. The system failed. The system failed us, obviously, and most of this pain that we are seeing in Main Street, this unemployment, was not caused by anybody but the system. And so it's one of the reasons why I think the leaders to be have no other choice but to open the printing presses and print as much money as Main Street needs in order to continue to have the trust and the confidence, you might say, of the system that the government is behind it. The alternative to that is very grim when you think about if we get a loss of confidence, particularly in the US dollar and US bonds, we could begin to see interest rates turn around sharper than you think because of the risk of pretty much the tremendous amount of money that's being printed that essentially can result and will result inevitably into inflation. And that, my friends, is the other side of the coin, or the rock, so to speak, that the Feds are faced with, that if we do see runaway inflation here, they have very little room to manage that with interest rates. And so prepare, because I think we're going to have some creative policies being implemented on the yield curve. And once again, trying to control and manipulate the yield curve and pretty much price discovery here in precious metals as they relate to the US dollar as the world's reserve currency. Once again, my friends, thank you for the opportunity to share this information with you. And I really sincerely hope that, once again, every day you come here, you become a better trader. Have a wonderful year, a prosperous new year. Prepare. It's going to be great. You take care. I'll talk to you soon.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.
The Ticker Talker app brings the powerful trading technology tools of the Ticker Talker desktop platform into the hands of its users who are on the go. Ticker Talker connects